Another bank has failed. This time it's Republic First Bank of Pennsylvania that's gone under, not to be confused with First Republic Bank, which went under last year. But it's not the failure of this relatively small regional bank from Pennsylvania that should concern you. The big story here is the government's response to this bank failure. Financial regulators are not giving us the whole story. One way or another, they're lying to us about what's really going on in the banking system. And as usual, the financial press is towing the party line instead of asking the tough questions. What's up, guys? I'm Nobody Special, and we got this from the FDIC on Friday. Fulton Bank of Lancaster, Pennsylvania, assumes substantially all deposits of Republic First Bank of Philadelphia. Now, you may have noticed the use of the word substantially in the headline there. Put a pin in that. We'll be back to that one. Also, it's worth pointing out that this was announced once again on Friday. It's funny that bank failures always seem to happen on a Friday.
Studies have statistically shown that there's less chance of an incident if you do it at the end of the week. Anyway.
Philadelphia-based Republic First Bank, doing business as Republic Bank, was closed today by the Pennsylvania Department of Banking and Securities, which appointed the FDIC as receiver. To protect depositors, the FDIC entered into an agreement with Fulton Bank National Association of Lancaster, Pennsylvania, to assume substantially all of the deposits and purchase substantially all of the assets of Republic Bank. And there's that word substantially again. Now, it's important to note for any customers of Republic First Bank that there's basically no change for you. You're not losing any money. Your money's still where it is. You can still use your checking account and your credit cards. Basically, you're going to be a Fulton Bank customer now instead of a Republic Bank customer. But I also want to point out this little detail here. The FDIC estimates that the cost to the Deposit Insurance Fund related to the failure of Republic Bank will be $667 million. So the FDIC is dipping into the Deposit Insurance Fund, which is their emergency bank bailout fund, in order to rescue Republic First Bank. That's an important detail. Now, it appears that the cause of this bank failure is virtually identical to what we saw last March. Republic First Bank had a large concentration of unrealized losses on its balance sheet from U.S. Treasury bonds. Remember, as interest rates rise, bond values fall, and since the bank took most of its customers' money and put it into U.S. Treasury bonds, they were losing money as interest rates were rising all last year. As of December of 2023, this bank had $262 million worth of unrealized losses on their balance sheet from those bonds, and it looks like that number has ballooned to $667 million based on the hit that the Deposit Insurance Fund took to bail out this bank. Now, Republic Bank also had a large concentration of uninsured depositors. That's people with more than $250,000 in their bank account. According to the letter of the law, the FDIC only guarantees the first $250,000 in any bank account. Everything above that is uninsured. And as of September of 2023, 54% of Republic First Bank's deposits were uninsured. So much like Silicon Valley Bank, this bank lost a lot of money on treasury bonds, and they had a lot of vulnerable customers who weren't protected, and uninsured depositors are easily spooked because their money is technically not protected by the FDIC. So a lot of those uninsured depositors started pulling their money out of this bank. Now, one unique thing about this bank failure is it took forever. This bank was delisted from the NASDAQ all the way back in August of last year for failing to file its annual report, and the FDIC was shopping this bank around as early as September last year, looking for buyers to come bail this bank out. Now, this story largely went beneath the radar, I think probably because the name was so similar to First Republic Bank, which had failed just a few weeks prior to this all happening. Now, ever since last fall, there's been negotiations going on behind the scenes as investors have been trying to take over this bank in exchange for pumping capital in to try to rescue them. Now, those investors trying to take over this bank were led by members of the Norcross family. That's a very prominent South Jersey family made up of lawyers and state politicians who are trying to bail out this bank in exchange for board seats. But it looks like that cash infusion all fell apart about a week ago. Now, over these last few months, while all these negotiations were going on, uninsured deposits dropped from 54% back in September all the way down to just 13% as of December. So it looks like those uninsured depositors, those wealthy clients, were given time to get their money out of this bank prior to this failure happening. And it's worth pointing out that interest rates have risen sharply since the beginning of this year, so those unrealized losses on U.S. Treasury bonds got bigger and bigger, and thus the hit to the deposit insurance fund as a result of this bailout got bigger and bigger, while those wealthy uninsured depositors were given time to get out of this bank. Now, it's also worth pointing out that there's been some very suspicious happenings at this bank going back for the last couple of years. This is in the Wall Street Journal on March 1st of this year, where their prior auditor, Crow, had flagged material weaknesses in internal control over financial reporting at the end of 2022. Now, material weakness in internal control over financial reporting, that's just a long-winded way of saying these guys are liars, that they're not telling the truth about the conditions at their bank. Now, Republic First said Wolf Company would be its new auditor, and the bank said in a statement that its management team has been working to address the issues, adding that most of them were the result of a core system conversion in 2022. So rather than admit that they were lying, instead they fired their auditor, replaced them, and said the reason why there's materially weaknesses in our financial reporting is because we upgraded our system in 2022, not because we were hiding losses or anything like that. Now, it's important to put the size of this bank failure into context here. What we're looking at on this chart is all the banks that failed last year over there in red, and then here's all the banks that failed during the GFC. You can see all the way over there, there's Signature and First Republic and Silicon Valley banks. They were the second, third, and fourth largest bank failures in U.S. history that all happened last year. And then here's the biggest bank failure in U.S. history, Washington Mutual, that failed during the GFC. Now, if we were to add a circle for Republic First Bank to this chart, it would be about the size of that little guy over there.
Oh, that little guy. I wouldn't worry about that little guy.
So when compared to the size of the banks that failed last year, Republic First Bank's collapse is really a non-event. So now we've established that the failures of this bank is, number one, nothing new, failed for the same reasons the banks failed last year, and number two, it's not that big a deal, this is a relatively small bank. Why am I saying that we've got a big problem here? Well, the big problem, is the government's reaction to this bank failure. Recall the use of the word substantially in the FDIC title. Fulton Bank of Lancaster, Pennsylvania assumes substantially all deposits of Republic First Bank of Philadelphia. That implies that not all deposits were assumed by Fulton Bank. Some of this stuff is staying at the FDIC. And recall the use of substantially here. To protect depositors, the FDIC entered into an agreement with Fulton Bank National Association of Lancaster, Pennsylvania to assume substantially all of the deposits and purchase substantially all of the assets of Republic Bank. What they're not saying here is that Fulton Bank isn't buying all of the assets and they're not taking on all of the liabilities. Some of that is going to stay with the FDIC. And also note they're making no distinction here between insured depositors and uninsured depositors. They're saying to protect depositors. So they're implying that even the uninsured depositors are being protected here. And the FDIC is telling us here that it's going to cost them $667 million to guarantee all of those deposits, which we can only assume includes both insured and uninsured depositors. Now, under the Dodd-Frank Act, all deposits above $250,000 are uninsured and are not supposed to be made whole in the event of a bank failure. They're supposed to get equity in the now worthless bank in exchange for those uninsured deposits. That's called a bail-in, and I made this video all about that. I'll put a link down in the description below if you want to go check that out. That is what is supposed to happen. That is, unless, of course, the FDIC invokes the systemic risk exemption. Now, the systemic risk exemption was a backdoor that was placed in the Dodd-Frank Act to allow the FDIC to declare mega banks too big to fail. Congress knew that they didn't want to do bank bailouts ever again, but that there may conceivably be a day when a bank so big was under threat that once again we had no choice but to bail them out. Now, the problem here is if uninsured depositors are being made whole at this small bank, Republic Bank, with only $6 billion in deposits, that means that the FDIC has just declared this little regional bank too big to fail. So if this bank is too big to fail, then they're basically saying pretty much every bank in the country is now too big to fail, and therefore all bank deposits at all banks are now by default insured by the FDIC, And they're doing that just through their enforcement of the law without any change to the legislation, without any act of Congress. Congress is sitting idly by while it happens, and the court system is doing nothing to stop it. Now, if a bank as small as this is really representing a systemic risk to our entire banking system, then the FDIC needs to come clean about that, because that means our banking system really is a house of cards that could go at any moment, and they're using the money that was set aside to protect the deposits of the middle class and the poor in order to guarantee the deposits of wealthy clients because of that systemic risk. And they've been talking about doing this for a couple of months now. Check out this in the Wall Street Journal from all the way back in September, talking about Republic First Bank again here. Should we be rethinking what it means to be systemic? The answer has to be yes, said Lawrence J. White, an economics professor at New York University and former banking regulator. With Republic First, we're just worried about pure contagion. The uninsured depositors at Republic First running, in other words, withdrawing their money, and that then causing other uninsured depositors at other somewhat similar banks running, and then the contagion grows. So what Lawrence White here, an economics professor at NYU and a former banking regulator, is saying is that even rich people at little banks losing money in their uninsured deposits would represent an existential crisis to the banking system that would cause a cascade of bank failures, and basically the contagion would grow out of control. What he's saying here is our banking system is a house of cards, and therefore all banks are essentially now too big to fail. Now, the Deposit Insurance Fund at the FDIC currently stands at about $121.8 billion, and that is guaranteeing $10 trillion of insured bank deposits. But there's an additional $7.5 trillion of uninsured deposits that by default are now being guaranteed by the Deposit Insurance Fund based on the words of this former regulator and based on the actions taken by the FDIC. And if that's the case, that means the workload of that money set aside to protect the deposits of the poor and the middle class has now virtually doubled in order to protect the deposits of the super rich. In other words, Main Street is footing the bill once again. Now, if that's really the case, then this relative non-event bank failure becomes a totally different animal and a massive story. And you'd think the financial press would be holding the FDIC's feet to the fire here, trying to get to the truth, but they're not. Once again, the financial press is towing the party line for the powerful and the elite, and they're telling outright lies here in the Wall Street Journal just from this weekend. They're saying since there is a buyer, the government won't be left with the decision over whether to backstop deposits over the FDIC limit of $250,000 as it did with SVB and Signature. Now, considering that nobody is losing money at this bank and the DIF is taking a $667 million hit because of this rescue, there is no way that this statement in the Wall Street Journal can be true. They're outright lying to the public about uninsured depositors being protected by money set aside to protect the middle class. And they go on to say the long, drawn-out failure also gave depositors more time to prepare as compared with the rapid collapses of last year. And yes, that is correct. This bank failure took several months. But what the Wall Street Journal is conveniently omitting here is during those several months, the wealthy were given time to abandon ship, and all the while, interest rates were rising, and thus the losses at this bank were getting bigger and bigger, and now the hit to the DIF is even bigger because those uninsured depositors were given time to jump ship. Instead of asking hard questions and telling the truth, the financial press is running interference for the powerful and the elite in order to reassure the public that everything is okay when clearly things are not okay in the banking system. So long story short, the failure of Republic First Bank is nothing to be afraid of. It's a small bank that failed for reasons we already knew about. The government's response to the failure of this small bank is something to be afraid of because the government, through its actions, has basically told us that every bank in the country is now too big to fail and that our financial system is so fragile that rich people losing money even at this little bank could bring that whole house of cards down. That's what their actions are telling us. All the while, they're giving us empty platitudes about how strong and resilient our banking system is when that is clearly not the case. And the FDIC's rubber stamp invocation of the systemic risk exemption means they have taken all of the changes to financial regulations that were made after the GFC and thrown them out to the benefit of the wealthy. They've done it without the approval of Congress. The courts are letting it happen, and the press is running interference, telling you all is well when clearly that is not the case. Till next time, live small and dream big.